Yesterday, BCE held its first investor day in more than a decade. Now, that stock still down more than 25% in the past 12 months. Our guest says there weren't any huge surprises. He has a buy on the stock. Jerome Dubreuil joins us now, research analyst in telecom and media at Desjardins. Jerome, thanks very much indeed for joining us. One interesting thing I thought in your report, you say BCE has now set out some public goals, and whatever is measured tends to improve. And so there'll be a discipline there. They'll need to reach those guidelines.
Yeah, thanks for having me. Good morning. Yeah, what we really liked about the guidance provided yesterday is two things. First thing, you kind of mentioned it, Andrew, is we like the accountability that having public figures set out brings to the management team. This should be a positive. The company is going to be measured against this over the next 3 years. And the second thing that the guidance for the next 3 years is really bringing, although you're right, it was pretty much in line with expectations, but really it shows that the stock or the company is going to be back to growing its top line and its EBITDA. This is a good thing, and this wasn't necessarily a given. There was no growth in EBITDA in 2025 that hurt the stock, as you mentioned. So it's good to see that the company is back to growing.
Now, the company was at pains to say our growth businesses are an increasing part of our franchise, and as opposed to the legacy businesses. So what are the growth businesses for BCE?
Yeah, you don't necessarily think about growth when you think about BCE, but that is increasingly the case. And some of the themes that are, we think, probably underappreciated by some of the investors. Two things that really caught our attention in the last couple of months. The first thing is Ziply, their investment in the U.S. We published somewhat of a contrarian note back in August saying that we like the transaction after running the math about it. We think it brings returns that are higher than the WACC. So this is underappreciated, brings growth. And the second thing that we got to understand a bit better yesterday is the AI Fabric initiative that the company has. This has been announced in May, but we had more details about it yesterday. And what was a bit of a concern for investors was that we didn't really have numbers about it. We didn't know how much it was going to cost, how much it was going to bring. And the returns on the AI investment look promising from what we heard yesterday.
In terms of earnings per share, though, you're not looking for a rapid ramp up here, I don't think, Jerome. So you say they had earnings per share just north of $3 a share in 2024, and that is likely to drop to $2.69 this year, and then get to $2.74 and $2.75 in 26 and 27. Now, I know it's such a complex organization, it's ridiculous boiling it down to just one number like that. But you're not looking for a rapid ramp up in earnings per share anyway.
No, two things about that is maybe first, investors we speak to do not tend to look at Bell on earnings per share basis, and one of the main reasons for that is it's a bit of backward looking at the amortization. This company has invested a lot in fiber. Will continue to invest a lot in fiber in the U.S., but that doesn't mean it's a bad thing. So the amortization there penalizes the stock on the earnings per share basis. And the second thing is, we like Bell, but we're not saying it's going to have explosive growth or anything. But we also do not think this is the reason why people put BCE in their portfolio. Bell is a stable business, brings stability, and we think at this level that it has found a bottom.
The yield, I mean, obviously BCE slashed the dividend just a while ago. The yield, something like 5%, a little bit more, and you see that as fully sustainable?
Yes, we think this is sustainable. The dividend situation earlier this year was unfortunate, but the company was really fighting with their hands tied with that dividend situation. We're glad the company did the right thing. You're right; it's trading at 5.2% yield. At this time, we think this is enough, and especially in the context that we do see that some of their investment brings sufficient returns or attractive returns. So when a company has good returns, we just don't see a need for the company to grow the distribution. So we're really comfortable with the company's decision not to grow the dividend for the next 3 years.
It blows my mind the way hydroelectric power has become so central to AI. So BCE says it has now secured access to about 500 megawatts of hydropower, and 73 megawatts was tied to a direct client. So that's amazing. So BCE now directly a player in the electricity market in that sense.
Yeah, I'm not sure I'd call it an electricity stock, but you're right to say that access to power is the main gating factor in AI and data center at this point, and having secured this access is going to be key for the company's success in the future in that front. And what's really interesting is that you mentioned the 73 megawatt deal that they have right now, and this is the only power that's included in 3-year guidance. So we are confident that they're going to be able to sell the capacity up to the 500 megawatt in the future. You know, companies were to be more careful with their data risk mitigation strategies in the future. So this is upside to the guidance that was provided yesterday.
Ziply, that was the big US fiber acquisition. It's stuck in the craw of some investors. I think they had thought, well, that money would be used to bring down debt. I guess one perception would be, well, you're in a really competitive market, fiber in the US, but you see upside here?
I do. You're right. That has been a pushback on the name recently. U.S. Fiber is in a land grab situation right now. But one of the presenters that were there yesterday is the CEO of Ziply. We think he presented very well, and he made some pretty good points about their ability to be deploying fiber in the future. And, you know, as long as the company is careful and disciplined with its fiber deployment, we do think they have the time to deploy a lot of fiber. You know, fiber in the US is still very much underpenetrated versus where Canada is. You don't hear that too often, but no. Canada is in advance versus the US at this time, and still a lot of fiber to be built in the US. So Bell is taking that opportunity. It's kind of an adjacent business. Obviously, we didn't think at the time of the announcement the deal was signaling something too good for the Canadian business, but can't blame the management team for going where the returns are.
And of course, before I forget, BCE is the parent of this network through its ownership of Bell Media. They sign my paycheck. What about the legacy businesses? Those are things like just home phone services for people?
That's it. That would be one. They also have satellite TV, a couple of B2B businesses that are still affecting the results. We think those business and their legacy aspect are very well understood at this point. And the interesting thing, you mentioned it, Andrew, is that these businesses are a smaller portion of the business now. This is declining. It's going to be less than 30% in 2028 of the businesses that are going to be in decline. So, you know, gradually these legacy businesses are becoming a smaller part of the business.
Jerome, we better leave it there. Thank you very much indeed.
Of course. Thanks for having me.
Jerome Dubreuil, research analyst in telecom and media, Desjardins.